Okay, so moving on to Chapter 7. Understand and be able to prepare the major elements of the master budget, and these brief exercises can help you. So sales budget, sales unit times sales price. Production budget, sales minus beginning finished goods plus ending finished goods. So this will definitely be tested, this production budget, on the exam. So on October 1, the Gala Manufacturing Company has 300 units of product on hand, so never disregard the units on hand. So that's like a beginning amount. Beginning units. And the company plans to sell 1,200 units, so they're going to sell this amount. They're going to need to have that many units on hand, or to produce that many units. And they have a desired ending inventory of 500 units. So ending inventory of 500 units. And so they already have 300 units. So they're selling this amount and they want to have this amount of extra in order, what if their sales prediction is wrong? So we need that amount just to be safe, like a safety stock. But we have already produced 300 or already have that 300 on hand. So we will add the sales minus the beginning finished goods, so minus the beginning and then add the ending. So I did that in the wrong order, so we'll start with the sales minus the finished goods beginning inventory and add the ending, if that logic makes sense to you. So we need to produce that much because we're selling that much. We need to have that extra safety stock at the end of the period, but we already have 300 at the beginning, so we can take that out from our requirements. So I got 1,400 on this question. And yep, 1,400 is the correct answer. So just knowing what to add and what to subtract in the production budget, which is, I think it's a little different from the other formulas we were looking at the previous chapter. So this problem, the following information relates to Minorca Manufacturing Company, and so for the month of February, I think our months are off, but I believe this is January, February, March. So January, February, March. Sorry that it doesn't say that. But so expected sales, so for February, they're expecting 390. I think we can use the same, I believe we can use the same formula. So 390,000, that's how many they're going to sell, so we need to have that amount. And they want to have a desired ending inventory of 30,000. That's the desired amount we want to have. So we need both of those, right? So for sure we're going to need that requirement, both of those. But how do I find the beginning? So the desired ending inventory of January. So at January 31st at 11:59 p.m. they have 28,000 units already at their ending inventory. Automatically this becomes the beginning of February. So at February 1st at 12:01 a.m. it's exactly the same. So that will be our beginning inventory. At 28,000 is our beginning. So following our formula, we start with the selling, the amount we're selling minus our beginning, and then add our ending inventory requirements. So I got 392 units, so I got C on this one. Yep. So on January 1, Barnes Company has 8,000 units of product A on hand. During the year, the company plans to sell 30,000 units of product A and plans to have 6,500 on hand at year end. How many products of A must be produced during the year? So same thing. So on hand they have 8,000 units, so that's our beginning. During the year they plan to sell 30,000 and 6,500 ending. This one minus beginning because we already have that, and we need the ending 28,500. So just the same problem again. So direct materials budget, raw materials needed minus beginning raw materials plus ending raw materials times by the raw materials price. The one I really want to emphasize would be the selling and administrative expense budget. So there can be a variable aspect. So variable sales and administrative expense rate times it by the sales in units. So that's our variable aspect. add our fixed component, and remember to exclude non-cash items for a cash budget. So non-cash items, the main one is depreciation. So you'll add everything up, the fixed expense and then the variable rate times it by the sales units, and then take out the depreciation expense because it's non-cash. So this company sells are planning on selling 1,300 units. 1,300 units. And the rate per unit is $4.20. So just like our formula said, we times the rate times it by the units, and then the fixed expense is $19,240. So this is our total expenses including depreciation. But we know that so it says it includes depreciation, but we know that for a cash budget we don't include depreciation. So we need to take that 3,380 out. So take out that depreciation. So the cash disbursement, since depreciation is non-cash, we are looking at $21,320. So we did our variable component and then we did our fixed component here, but take out the non-cash element to get our amount. Yep, and so same thing with here, you'll times the 4,600 times it by the variable aspect, add our fixed component, and then take out our depreciation. And so moving on to our cash budget, you'll start with the beginning cash budget, cash balance, add our cash receipts, and then these are practice problems. So add the receipts minus the disbursements. So pretty straightforward. So start with your beginning cash that you have on hand, add the receipts, add what's coming in, minus the cash disbursements. So this is your cash excess or deficiency, and so that'll be a question on the exam. What is the cash excess or deficiency? And they'll tell you the cash receipts, cash disbursements, beginning cash balance. So they can ask you for the cash excess or deficiency, or they could ask you for how much you need to borrow in order to get the amount you want on hand. So with these, you'll have your cash excess and deficiency, but you need to remember that there's always like a requirement, a minimum amount of cash that we have on hand. And so if you don't have that minimum amount on hand, say they want, $10,000 or $30,000, you'd have to borrow that amount to get that beginning minimum balance in order to maintain that minimum cash on hand. And so that's how you'd use financing to get your ending cash balance. So for example, a cash budget, let's see. So this is the cash collected, and so this is a cash collection budget. So not exactly what I was talking about with the cash receivable budget, but this is how you would know the cash receipts for the month by doing this a problem like this. So all of Gaylord's company sales are on account. 35% of the credit sales are collected in the month of sale, 45% in the month following the sale, and the rest are collected in the second month following the sale. Bad debts are negligible and should be ignored. So bad debts means there are no bad, they're collecting everything that they're selling, so they're negligible, it should be ignored. The following are budgeted sales for the company. So this is the amount of sales. How much cash would you collect in March? So 35% in the month of sale, 45%, and the rest are collected in the second month. So for me, it helps me. So 35 in the first month, 45 in the second month. So what are we at? This one plus this one. We're at 80%. So then the following month we'll collect the full 100% since there's no bad debts, right? So month 1, 35%, month 2, 45%, month 3, 20%. So, and this is asking for March. Oh no, if it doesn't say what month it is, we won't know what March is. Let's see, January, February, March, April. Okay, I guess we'll say January, February, March, April. Hopefully that works out. Let's see. Okay, yeah, so January, February, March, April. Sorry about that. So January, and we're just looking at March. So March is our key month right here. March. So we know in March we have 40,000. So we know following this, first month, second month, third month, fourth month. Oh no, not fourth month, we've already collected it. Okay, so March is the first month that we're collecting this 40,000, so we're getting 35% of this 40,000. Okay, but we have, so for February and January, we have 50,000 and 60,000 in sales. So in January we're collecting 35% of this 50,000. We're collecting 45% of this 50,000. This 50,000, and then March we're collecting 20% of this 50,000 of the 50,000 over here, right? So if we were to do a calculation, so 1 times it by 35%. Oh, I don't know if that worked. 35%. Oh, we're in percentages, that's why it's not working. 14,000. And then 20% of January, because it's the third month. And then for February, the 60,000, we're collecting 45% of it in the, we're collecting 35% of it in February and 45% of it in March, because that's the second month. So 35% of the 60,000 and then 45% of the 60,000 in March. So just laying out the schedule and making it more understandable for you will make it easier for you to calculate how much is collected in each month. So 51,000 is the answer that I got. So because 35% of it was collected in March, 45% in February, and 20% in January gives us our total of 51,000.